Oh, hello, this is Vicky Pryce. Welcome to the Moneycorp Winter Economic Update. Of course, the world right now is worried about a number of different issues, trade issues, which are still there. We have Brexit issues for the UK in particular. The coronavirus, of course, is making people rethink where we might be going in the future. Here in the UK, we're going to have a budget on March the 11th, unless that changes in the next few days. And there is a lot of speculation as to what that might include. And of course, what we've seen in the UK, certainly at the end of last year, is quite a slowdown in growth, but a lot has happened since. So let's look at what happened in 2019, first of all. If you look at the one country that was supposed to be growing fast because of substantial injection of funds by President Trump, the US, we've seen how it's been affected itself by the trade disputes. It's really interesting that manufacturing production has been declining for a number of months. And that, of course, is probably behind the willingness of President Trump to at least move ahead and sign some sort of deal with China before the coronavirus, of course, hit, because manufacturers were already complaining that there were problems with input costs because of the tariff regime that he had instituted, and he needed to move forward to ensure that manufacturers in the US were able to provide the goods that they were supposed to at reasonable cost. So we can see here in this slide how what has been going on internationally has been having quite a substantial effect on the US, and therefore something needed to change, and something did change. Before Christmas, there was the signature of a pact to at least allow for some tariffs to come down and to also allow for talks for doing a lot more in the future, perhaps, coming up at some point. When we look at Europe, there has also been a big issue of slowdown, particularly, of course, because of the trade slowdown that's taken place. If we look at trade itself, world trade probably was more or less stagnant for the whole of 2019. Countries like Germany that export a lot to China and depend hugely on openness and no friction in the trade have been quite severely affected. So what we saw earlier in the year is a decline in GDP in Germany in the second quarter rather of 2019. The third quarter, a bit of an improvement, but stagnation in the fourth. And countries like France and Italy saw declines happening too. So the Eurozone has just not been performing, mainly because of the trade concerns. If we look even further afield, we can see here, first of all, what is happening with intra-EU trade, which has been slowing down very significantly, and exports from Europe to other countries, and particularly, of course, to China, have been severely affected by the slowdown in that country. But look at Japan, where, of course, they have been major exporters to China in the past, and they've seen themselves a severe slowdown in exports to that country because of the trade disputes. And that, of course, has spread quite widely. South Asia has been very negatively affected by the slowdown in China, and that has, of course, led to revisions of what trade might do this year, 2020, and it has been a major reason for why world growth in 2019 was way below expectations. So the IMF, at the end of 2019, started rethinking its forecast, and at the World Economic Forum event in the end of January 2020, they produced their revised and downward forecast for the world. And we can see here that we're looking at growth perhaps next year of 3.3%. That's below what they were expecting before. Still an uptick, but remember, the IMF and most of the world organizations, if they don't actually achieve the growth they're expected in 1 year, then they assume it will happen next year. So they have tended to be on the optimistic side and have then spent the entire year revising the forecast downwards. So who knows what will happen now, of course, because of the coronavirus, but they were looking at least at the trade disputes looking a little bit less intense when they revised their forecast downwards a little bit, but still assuming that if they get resolved, they would lead to growth in 2020 and 2021 being higher than 2019. Let's see if that happens. Within that, of course, the euro area not doing particularly well. Growth of 1.2%, 1.3%, and so on is not necessarily conducive to any substantial further reduction in unemployment. They have seen some improvement there, but this type of growth is very anemic. And of course, it matters a lot for us in the UK doing business with the euro area, given that we export some 45% of our goods and services to them. So if you look at the detail of what is likely to be happening in each individual country, if you look at columns 3 and 4, these are the projections for 2020 and 21, the latest ones. They've been revised from earlier projections. If you look at the last 2 columns on this slide, you can see where they were back in September. So downgrading and downgrading again. They've done that, as I said earlier, a couple of times already through the year. But of course, they might have to do this again because we now have added problems in the shape of the coronavirus, which is a bit of a shame given that things had started to look like they were going in the direction of the new forecast, which still had growth slightly faster for 2020. What we saw has been some improvement in the confidence indicators, whether you're looking at business indicators or consumer indicators. As you see here, that consumer and business confidence, this is the aggregate indicator, having both of those in there, had been declining for some time. It has been picking up at the beginning of 2020, which gave everyone a bit of room for hope. And if you look at the PMI composite, which is the Purchasing Managers Index output composite, which looks at all aspects of the economy, such as manufacturing, services, and construction, what we saw there too is that output was beginning to recover in January 2020. Similarly, in places across Europe, Germany has been suffering for quite some time from the decline in demand for products that it produces across the world, particularly China. Manufacturing is beginning, or was beginning in January, to tick up a little bit. Now, of course, you have to read this particular chart with great caution because it's still a decline. Anything below 50 suggests a contraction, but at least it was slightly less of a contraction than people expected. And the way the headlines go is improvement and rise in German GDP, whereas what we're talking about is just a slower contraction, but at least some signs of improvement, some green shoots perhaps in Europe. And what you've seen in relation to the consumer, because there has been some improvement in employment, there has been some improvement in wages, the consumer was also beginning to feel a little bit more optimistic right at the beginning of 2020. But if you look at businesses and what they have actually been doing on the ground, quite a lot of the impact of the trade disputes has been in a number of sectors, such as the car manufacturing, which have shown declines across Europe and certainly declines in the UK as well. And even in early 2020, industrial production actually remained subdued. And that's a bit of a worry because if you add to this now the coronavirus impact, that would mean that the likelihood is that we're going to be seeing contraction appearing again in the following few months. And Europe still has a serious problem in relation to its debt position. If you look at individual countries, remember that to be members of the Eurozone, one has to have a debt to GDP ratio of no more than 60%. Well, the Euro area as a whole is not meeting this. And some countries, of course, are way, way above even the ratio, which is considered to be at least sustainable for the long term, which is 90%, according to the IMF, where we've exceeded that in a number of countries. And that, of course, is still exerting a downward pressure on growth in Europe. We've seen now, of course, that There is quite a lot of disagreement about what to do with the European budget, which is being negotiated now for the next 7 years. It will actually last for 8 to 2017 inclusive, but we're already, way past the beginning of 2020. What is happening is that the countries that need it most, such as Greece and Italy and Spain and so on, and some of the Eastern European countries, or former Eastern European countries, are all asking for a little bit of extra money to get them through a rather difficult period. They have to deal with migration, flows, and so on. But there are a number of other countries that are still insisting that the budget should be restricted to no more than 1% of the EU's GDP. And of course, having lost the UK's contribution, they are cutting back on what might be recyclable to the poorer countries in Europe. And that is holding up the discussions on the budget at present. The markets, of course, have begun to get increasingly worried because of the coronavirus. So although we had this improvement, not a huge one, but a little bit of an improvement in early 2020, what we're seeing is that there is a serious concern about what the long-term impact of the coronavirus might be. In China, the purchases of new cars has gone down very significantly. Just the first 2 weeks of February have seen practically no interest in anyone buying any cars. Of course, hardly anyone can move in some parts of China right now, despite the fact they're supposed to have gone back to work on the 10th of February. So you can see the year-on-year change in vehicle sales, passenger vehicle sales, down by 92%, which is, of course, having a direct impact on everyone else. And supply chains, too, are being disrupted all across Europe and elsewhere because, of course, the number of component parts come from China. And it is beginning to make people think again about how they should offshore a lot of the production that's taking place right now, and whether some of it should be onshored or at least happen somewhere closer where they can have more control. And that may indeed require a huge rethink in manufacturing in the future. Now, why should one feel the slightest bit optimistic? Well, the G20 had a meeting which just finished on Sunday in late February, on Sunday the 23rd, and they've issued a statement saying that the coronavirus might take some 0.1% of global GDP off. Well, in 2020, I hope they're right that that will be restricted to that. What they are actually expecting is that there will be a lot of support by the monetary authorities with either cutting interest rates or a lot more liquidity coming into the market than we already have seen. Well, the stance had been very accommodative in most parts of the world. China, too, in a way, but China tends to tighten a bit, then actually put a lot more liquidity in the system. And this is exactly what they're doing right now. And the expectation is that other regions would do the same. So monetary authorities are getting ready to put more cash in the system. The Japanese have said they're all ready for the coronavirus impact, for example. But of course, interest rates across the globe are very low, at record low levels. In some places like the Eurozone, they are negative for deposits of banks with the European Central Bank. So how much further one can go, is debatable. So there are concerns as to what the impact of this might be and whether indeed the instruments that are at present in one's disposal are going to be sufficient. Not surprisingly, we have gone back to seeing an inverted yield curve. What's going on, of course, right now is that because everyone is concerned about the impact on share prices, particular sectors that might be affected by the coronavirus, not just the car manufacturing sector, but also services more widely, tourism, airlines, and so on, and also the banking system, money is being diverted back into bond purchases, and yields are falling as we speak. So it also, of course, indicates that everyone will be expecting interest rates to be lower in the future than they are now, which normally assumes that there will be a recession. It may not be what this market is expecting right now, but it certainly is expecting interest rates to be low and perhaps share prices to come off some of their peaks that we have seen. Well, meanwhile, in the UK, the interesting thing is that, again, here, we had seen some improvement taking place following the election, which at least took away some of the political uncertainty. What had been happening through 2019 and certainly also the latter part of 2018 is that businesses faced huge uncertainty and therefore they were not investing. Confidence was low. At least one of those political uncertainties went after the election. There was still, of course, the issue of Brexit, which is not clear right now, but businesses that had been holding back are now using some of the money available to increase production and also hopefully to start investing a little bit more. We're seeing the manufacturing PMI improving. We saw a substantial improvement in January, and that improvement seems to have been sustained in February too. We haven't seen that type of growth above 50, which is 50 stagnation. Anything above 50 is an improvement. So things are now moving towards a positive territory, and that is pretty good after stagnation again in the UK in the last quarter of 2019, where manufacturing and services were pretty subdued. The interesting thing is that when one looks at the figures in more detail, one realizes that the only way we managed to get even stagnation in the UK has been because of extra government spending on current services. So that's quite interesting. And with the budget coming up, one wonders whether that will need to be sustained in the future as well. So if we add to manufacturing, services and construction, again, we've seen, in fact, the improvement taking place very dramatically, which is now moving it way above the stagnation phase to something much more positive. House prices have picked up. A lot of movement has taken place there too. And that had been a sure sign that things would improve. Nevertheless, the Bank of England that produced its forecast in January, at the end of January, actually in January 30th, which was just before, a day before the UK officially left the EU, predicted that even if there was a trade deal that was smooth and would be extended to, practically the whole of the economy, we would still only grow by 0.8% in 2020 and only by 1.4% in 2021 and 1.7% in 2022. Hardly huge growth. They had downgraded it from previous expectations. They were waiting to see whether some of the indicators would be better before deciding what to do with interest rates. They decided to leave them unchanged. Now, if the coronavirus starts having more of an impact, then at least there is a little bit of a room there for the Bank of England to act. And as we know, the European Central Bank has already started buying bonds again in the secondary markets by having QE, quantitative easing, reintroduced at the end of last year. I spoke about house prices. The interesting thing is that the house price increases that I mentioned have been seen all across the UK. Yes, London has benefited a little bit after very, very slow growth last year, but we've seen some other regions across the UK doing well. Of course, it's possible that the talk of levelling up that this government is now talking about, a lot of infrastructure spending taking place in the north and not all concentrated in London and the southeast, may be having an impact in confidence in those markets. And even retail sales picked up in the month. So if we look at last month, retail sales went up quite substantially. Unfortunately, on a 3-month basis, they were still down, but you can see quite clearly that one of the impacts on retail sales has been the turnaround in wages, which is improving, and not so much as people had hoped, because the improvement has come down a little bit in recent months, but at least there is now a positive real wage growth, a contributor to retail sales. And now we're just back in terms of hourly earnings to where we were in real terms before the financial crisis. Not a huge, huge achievement, but at least we're back there now, for certainly for the time being at least. What has happened, of course, in the financial markets is that the changes that have taken place have been reflected in both share prices and, of course, the exchange rate. Huge volatility. We can see here the ups, the sort of highs and lows, certainly against the euro in the period since we left the EU and also in the run-up to it, things had been strengthening because, of course, we had finally moved away from that political uncertainty. But you see what happened in February, quite a big variability there in terms of the highs and the lows. And of course, where the coronavirus will leave us in comparison to other countries remains to be seen. So what next for the EU? We've seen some improvement. The external environment, of course, is pretty tough and maybe getting tougher. We still have issues about how the EU-UK trade negotiations will go. We've seen pretty clearly that the two sides are quite apart. This week is when we're getting the detail of where the UK is and also where the EU stands. We're not actually starting proper trade negotiations until March 3rd and see what happens from then on. But of course, the UK has already lost quite a lot of its growth that it would have had without the referendum. The calculation is still that we've lost some 3% of growth and quite a lot of productivity. And the growth in the future is likely to be less than it would otherwise have been. The trade negotiations themselves are going to still give a lot of uncertainty to businesses. And the question is whether, in fact, we're going to see any real pickup in investment, which has been a main reason why growth has been so slow. What will happen in particular sectors in relation to regulation? It's uncertain. We move from one statement that says we're going to follow them with another statement that says we're going to actually be non-aligned, which is confusing markets right now. A lot of infrastructure spending is expected, nevertheless, to make up perhaps for some of this uncertainty. HS2 has been given the go-ahead, and there could, of course, be a lot more extra spending. We've already heard some of it, but there could be a lot of extra spending in the north. How much more room is there going to be in the budget for any giveaways? The austerity really over? We don't know what the fiscal rules will be. It's quite likely that some semblance of fiscal rules will still be there when we hear the budget. But there isn't much headroom in terms of allowing for a lot more spending on current services, and yet lots of departments have already been told to come up with 5% reduction in their plans. There's a spending review that's going to take place, a lot of uncertainty there, and also whether tax increases are going to happen or not. Loads of them are being suggested, but then denied. So I think right now we're not at all in the clear. We have a new chancellor after Sajid Javid lost his job, and it's all being worked out as we speak. But finances will be under strain. If there is less growth, less will be collected, and that will constrain how much of a giveaway perhaps there might be, and the need of stealth taxes is going to be there. So finally, where are we with the UK trade deal? I think the issues of a level playing field are going to be very important. That's one of the big differences that exist. The EU, because we're so close to them, doesn't want us to institute any changes, which might mean that we compete against them unfairly. State aid rules, how will we be in the future? We're going to really be allowed to move in and support companies in difficulty and completely ignoring what the rest of the EU does. Non-tariff barriers are going to be very significant. What happens to the financial sector, which is, of course, so important for the economy and which employs 2 million people right now? Are there going to be difficulties there in the future, and also for the rest of the service sector too? A lot of discussion about fisheries. It is a very emotive issue. We have seen that the French are very keen to ensure that they still have access to our waters, and that is working still in a reciprocal fashion. That, of course, is against what has been promised, perhaps, into some of the areas where the Conservative government has made a significant gains. So the thing to remember, of course, is that we tend to import a lot of the food we eat from the EU, and we tend to export most of the food, most of the fish that we catch to the EU as well. So quite a lot of the fish processing and food processing companies are quite worried about any loss of access or any tariffs that might be imposed. Immigration is going to be an issue. We've had the new rules that have now been announced, which of course will affect large sectors of the economy, particularly hospitality, tourism, and so on. So there is a lot of concern about what it will mean in the future in relation to any constraints on growth. And then, of course, the whole issue of standards. The chlorinated chicken issue is still reverberating. If we're going to be having a deal with the US, who knows whether that is going to be an issue that might break any discussions that we may have, or whether we might indeed be quite prepared to compromise in that area. The EU, of course, itself is changing. I mentioned the budget already, but there are considerable issues in relation to how the Eurozone itself is run, whether there should be some relaxation on the fiscal side to allow for more growth in the future. But countries, despite the fact that we'd like to think that they are divided in relation to how they look at Brexit, in fact, they're quite united, and they're likely to prove quite tough negotiators as a result. There is a lot more unanimity in terms of getting better institutional backup for the Eurozone in the future, with thoughts again on how to integrate better the whole sort of banking system, also how to move into a single digital market, a single energy market, and make actually Europe more generally, the 27 countries and not just the Eurozone, be considerably more integrated and benefit from that. So it is going to be a tough environment. The next 12 months, or maybe 10 months to the end of the period that we still have left before the time when we are allowed to continue to operate as if we're still in the EU elapses. So are we likely perhaps to get a further extension of what this transition period might be? Are we likely to get only a very simple deal that isn't going to satisfy anybody really? Are we perhaps going to have a no deal in the future? All these things are worrying businesses right now. It will be interesting to see how that is reflected in the next round of surveys on confidence, but one can only keep one's fingers crossed that the improvement we saw at the beginning of 2020 can be maintained despite coronavirus and everything else. That's it from me, and goodbye until the next Moneycorp update. And if you have any questions, please get in contact with your account manager at Moneycorp. And thank you very much for joining.